Well, welcome to episode 2 of our debt sale mini-series. My name is Joseph Schuster, and I'm a partner in the Consumer Financial Services Group at Ballard Spahr, and I'm one of the co-hosts of this podcast mini-series. In our first episode, we laid the foundation, what a debt sale is, how it works structurally, and why companies choose to sell debt as part of their overall recovery and capital strategies. In this episode, we're moving from the why to the what. Specifically, we're going to talk about what types of debt can be sold, the types of products, the types of accounts within those product types, how those portfolios are typically composed, and where the practical and legal boundaries start to matter. We'll walk through the kinds of consumer and small business products that are commonly sold, how buyers think about specialty accounts, and why diligence and portfolio composition are often just as important as pricing. We'll also flag the types of accounts that generally raise red flags from a legal, regulatory, risk, business, pricing perspective, and why those issues tend to surface later if they're not addressed up front. As with the rest of this series, we'll look at these issues from both sides of the table, the business realities driving the buyer behavior and the legal considerations that shape what can actually be transferred and collected. With that, before we jump in, Chris, if you could please reintroduce yourself.
Absolutely, Joseph. I'm Chris Eastman. I'm the founder and CEO of Franklin Ross Strategies, a consultancy that helps with their collection and recoveries needs to include debt sale, both as a leader of fintech and banking collection and recoveries groups. And I was the former CEO of Pender Capital, one of the largest debt buyers in the medical debt space. So I bring expertise and experience from both sides of the table on debt sale transactions.
Great. Thank you, Chris. As a starting point for this episode, I think it would be good to explain the types of debt that can be sold and the types of debt that cannot be sold or products that cannot be sold. I might not even use the word debt in some of those instances. But Chris, do you want to kind of start off with the different types of products that can be sold, that you're seeing sold, some of the things that might be newer that entities are selling?
Absolutely, Joseph. So I think there's a number of emerging categories in the debt sale space that are attracting significant interest from some or all of the debt buyers. I'm seeing BNPL really spike in terms of interest. The buy now, pay later space, as that continues to grow, debt buyers are increasingly interested in purchases there. The rent to own or lease to own space, I've seen a categorical increase in interest on that product as well. Telecom and medical debt continues to generate interest. Sometimes you have specialty debt buyers in that space that focus on telecom and medical. And these are, of course, in addition to your standard products that have attracted interest, credit cards, personal loans, auto deficiency balances. And then on the small business side, we continue to see robust interest in purchasing term loans, credit cards, and small business lines of credit. I think the important thing to think about here is that not all debt buyers are necessarily interested in each of these categories. Some have significant expertise, whether it be underwriting models that do very well on some of these products or previous experience. It's been positive purchasing and collecting on these types of accounts. And so some will participate in certain specialty areas and not others. And it's really about knowing what the market looks like and having that connectivity to the different buyers to know who's going to buy what and what kind of pricing they might be willing to pay based on their ability to underwrite and price in the space.
And maybe that's actually an area, Chris, that you could touch on a little bit more, that pricing, how this is not, the buyers are not commoditized in this space to the extent that you're saying that there really is a difference based on the product type. And so you may have large disparities when you're looking at that pricing, but and in particular with different products, to the extent that a debt buyer is more comfortable with a product that somebody else might be newer to that area on. But maybe you could just touch on that pricing a little bit with respect to the different accounts and as we look at different debt buyers.
Yeah, in my experience, debt buyers tend to be a little bit more conservative as they're approaching a new asset class, given that they don't have experience in terms of how the accounts are going to liquidate. So most of them use underwriting models to price out accounts. So they have a fairly good view of what the consumer looks like. It's going to be how does the consumer perform within that specific product type that they're trying to price out. And they're also going to consider what kind of collection activity they're going to be comfortable taking with that specific product type. So there's a lot of things that go into that I'm sure we're going to talk through in future episodes, but it really is how they're going to collect on it and the collectability of that. And then how does that product interact with the consumer to really allow them to underwrite and price the product out.
Great. And so I just want to add a little bit to the types of products and what's not sold as well. Additional products that we do see being sold are small dollar lending. They may be single payment products, things of that nature that are in default, and student loans, which, again, these are areas that some debt buyers are not as interested and may not be buying these areas, or some of the other areas that Chris said. Others are interested, and the ones that are interested in buying these, the price difference can be fairly substantial. So, that goes again to the diligence that we talked a little bit about in that first episode. The one area that I would mention, and there are some different products that are not sold, but the one that I'm going to specifically mention is earned wage access. That is something that product is specifically set up so that they are non-recourse products, so that it is not credit. And assuming it's set up as beneficial as possible to defend that position. With respect to the different accounts, so I'm just going to add from a regulatory perspective, there are different considerations that the debt buyers will look at. And we generally represent the sellers in these transactions. And so as we represent sellers and we help people get their portfolios ready, from a diligence perspective, the debt buyers will be doing diligence on the sellers. The sellers will also be doing diligence on the buyers. We're going to get into that in a future episode. But when the sellers are preparing the materials for the debt buyers, there are things that should be gathered. And each type of debt that could be sold has different things associated with it. The original contract, whether it's a credit agreement, whether it's a lease agreement, a rent-to-own agreement, a phone agreement, that contract that ultimately led to the debt is something that needs to be accessible for that debt buyer. They will ask about that. There will also be questions about what's been done from a regulatory perspective. What licenses exist? There are probably going to be some specific questions about communications that are sent to the consumers. There will also be questions about the collection strategies that were used. Chris, I think, can get into that a little bit more from a business perspective, but those will be looked at as well to say, are there any regulatory concerns that would impact the ability of the debt buyer to be able to collect on this debt that they're looking at pricing? It doesn't mean that the debt can't be sold to the extent that there are things out there, and there may be reasons, and we certainly help with what the reasons could be for some of these different things. But being prepared for all the different items that come up in the regulatory due diligence that the buyers do makes that pricing process that Chris was talking about a lot faster. Because practically, like, how this will work is you'll identify a population that you want to sell of accounts or debt, and then you will put together an offering memorandum that explains that debt, what type it is, what it's composed of, all of these different things. And that will go to debt buyers. They'll have a specific time period during which they can review it, review items in the data room, and submit a bid with respect to that debt. During that time period, they're asking these regulatory questions. Obviously, you've put everything together that the debt buyer can look at high level, but they'll then be asking some specific questions based on their experience. Certain states, there have been different items happening from a litigation perspective, from a regulatory perspective. Being prepared for those early on does help tremendously with the pricing. That if a question comes in and we're able to respond very quickly to it, the debt buyers ultimately will have more confidence in what we're selling, and I think that does lead to a higher price. Chris, would you agree with that?
Absolutely. I think the more information that you can provide upfront to the debt buyer as it pertains to the background of the accounts and the collection history, that's going to allow them to price it more accurately and ultimately, I think, lead to the best outcome in terms of finalizing and closing a deal.
Chris, maybe at this point we look at a little bit of the different segmentation that exists within the types of debt. The different types of debt will ultimately have subcategories, and those will be explained in that offering memorandum that I was talking about. And maybe you could just talk a little bit about what some of those different segmentation types are and where potentially buyers might not be interested in it, or where the segmentation can lead to maybe one buyer buying some areas and another buyer buying other areas.
Absolutely, Joseph. So, this is a question that constantly comes up with sellers in terms of which accounts should I include in the debt sale? Which accounts should I maybe exclude from a debt sale? because buyers may or may not be interested. And what I found is there's a lot of categories where sellers are maybe worried that there is an interest, where there may be no issues from a buyer perspective at all. These are things like cease and desist accounts or do not call accounts that have been flagged by the seller. Oftentimes, buyers are quite comfortable purchasing these. And other examples are accounts where the customer may be represented by an attorney. One thing that's very attractive to debt buyers are accounts that are working with debt settlement accounts. I've seen the price for these be above 20 cents on some trades. So, there can be a lot of specialty accounts that create a significant opportunity for value from a seller perspective. Additionally, other accounts that are in legal situations like bankruptcy, those can be structured into a sale as well. And buyers are overwhelmingly willing to buy accounts that are bankrupt. There's just specific pricing for those, depending on whether they're Chapter 13 or Chapter 7. Would be out of stat account. Here's one where some sellers are willing to buy and others may not be. I think in all cases, though, you should expect to get a much lower price on out of stat debt than in stat debt. And it's just something you need to think through and be prepared for in the event that you do sell it. To this end, there's even portfolios of accounts or specialty portfolios that buyers will be willing to engage on. And so I've seen entire portfolios of bankrupt accounts go for sale on the market and do quite well. And debt settlement accounts is another area where buyers are interested in acquiring whole portfolios of those and will bid on those separate from other accounts that are coming for sale if you choose to execute a sale that way. And so I've worked with buyers to put out portfolios of bankruptcy accounts, portfolios of debt sale accounts alongside portfolios of just regular charge off with a hodgepodge of different account statuses on them. I'll also highlight, what accounts buyers tend to want to avoid. And I think generally this aligns with what's best for the seller as well in terms of risk, either regulatory or reputationally. I've seen that buyers generally will not buy accounts that are deceased. Those generally don't have much value, although there are specialty buyers you can work with that will buy deceased if they're sold immediately after the deceased notification has occurred. Oftentimes, buyers won't buy accounts with open or unresolved fraud issues, any accounts with outstanding legal action on them, whether the buyer is taking legal action or there's some sort of regulatory legal action surrounding the account. Both those generally will be something buyers will not want to participate in. And any account that doesn't have a clear chain of title and or some of the documentation in terms of account history, transaction history, which could call into question, maybe the balances. Joseph, would you add anything here in terms of accounts that oftentimes buyers will be willing to buy and then those that they aren't?
I think you've hit all of the areas where there is sometimes a pause from a buyer about purchasing. The one area that you finished with that I think is generally non-negotiable is with respect to that chain of title. If you can't show chain of title, that's going to be a very difficult thing for a debt buyer to get over. There are a lot of consent orders on that with respect to a debt buyer trying to collect on a debt that does not have that clear chain of title. The other piece, though, that I'll just kind of add as well, that when you're going through all of this, this is where that diligence process becomes so important. And these are things that you can know all the questions that are going to be asked by the debt buyers, and based on the portfolio composition, Chris and I are able to kind of look at who the possible debt buyers are and what those questions are going to be. It is beneficial to kind of go through that and be prepared for all of those things up front so that when these questions come in, what the responses are. That's ultimately going to lead to the best pricing with respect to particular asset categories and the segmentation within those asset categories that Chris was going through, and to help with that offering memorandum to say whether there should be to solicit bids based on the different segmentation of the asset types. I think that where I've seen sales run into difficulties, there's a number of these different things, and we'll get into them in future episodes, are where there is data hygiene issues, where you can't show that clear chain of title, or you have difficulty knowing the status, that segmentation that Chris was going through of the different account types or debt types that might exist within the asset class. To the extent that those exist, this can be a much simpler process. And then we take all of that that's done from that diligence, that's in that offering memorandum, and that really becomes something that does go into the purchase and sale agreement of what the seller is promising that they're selling, how it relates to that offering memorandum, how it relates to some of these questions, and how we're making those representation and what the buyer is ultimately reviewing too. We're many times able to say that the buyer has had the chance to do the due diligence that they require, and we've answered all of the questions that they have. In order to be able to do that, this upfront diligence can be extremely beneficial. So with that, I think we'll wrap up this episode. And I think really the point that we're making on this one is that almost any debt can be sold. Not every buyer is going to want to buy it, and the pricing is going to be different. But basically, anything that's out there can be sold in one form or fashion. We'll talk about some of those in the future episodes. On our next episode, we'll talk about who buys debt, how they think about that value, and how these deals can get structured. Thank you.